Investors are always on the lookout for strategies to outperform the market. One such strategy, often whispered about in financial circles, is sector rotation. This approach involves strategically shifting investments between different sectors of the economy. By understanding the cyclical nature of these sectors, investors can potentially enhance their returns. Imagine a farmer planting different crops throughout the year. Each crop thrives in a particular season. Similarly, different sectors of the economy flourish during specific phases of the economic cycle. Sector rotation is about understanding these cycles and adjusting your portfolio accordingly. It's about being in the right place at the right time. We all know that certain industries perform better during specific economic conditions. For example, when the economy is booming, people tend to spend more on discretionary items like cars and vacations. This benefits sectors like consumer discretionary and industrials. We'll explore the economic cycle and its impact on different sectors. By the end, you'll have a solid understanding of how to incorporate sector rotation into your investment strategy. Sector rotation is a simple yet powerful investment strategy. It involves shifting your investments between different sectors of the economy based on their expected performance in the prevailing economic climate. Think of it as adjusting your sails to catch the wind. As economic winds change, so too should your investment strategy. The stock market is broadly divided into 11 sectors: energy, materials, industrials, consumer discretionary, consumer staples, healthcare, financials, information technology, communication services, real estate, and utilities. Each sector has unique characteristics and responds differently to economic shifts. For example, consumer staples, like food and beverages, tend to be less affected by economic downturns, as people still need these essential goods and services. In contrast, consumer discretionary sectors like automobiles and luxury goods are highly sensitive to economic fluctuations. By understanding which sectors are likely to outperform in different economic phases, investors can position themselves for success. In essence, sector rotation is about staying one step ahead of the market. The economic cycle is like a symphony with different instruments playing their part at various stages. Understanding this cycle is crucial for successful sector rotation. The cycle typically goes through 4 phases: early expansion, late expansion, early contraction, and late contraction. Each phase presents unique opportunities and challenges for investors. During early expansion, the economy emerges from a recession. Interest rates are low, consumer confidence is rising, and businesses begin to invest. This phase favors sectors like technology, consumer discretionary, and industrials. As the economy transitions into late expansion, inflation starts to pick up and central banks begin to raise interest rates. Sectors like energy, materials, and financials tend to perform well in this environment. Early contraction marks the beginning of an economic slowdown. Defensive sectors like consumer staples, healthcare, and utilities tend to outperform as investors seek safety and stability. By understanding the characteristics of each phase and the sectors that typically outperform, investors can make more informed decisions. It's like reading the musical score and anticipating the next movement. The early expansion phase is like spring after a long winter. The economy awakens from its slumber and the seeds of growth are sown. Interest rates are low, encouraging businesses to borrow and invest. Consumer confidence rises, leading to increased spending. This phase is characterized by a surge in demand for goods and services, creating a favorable environment for growth-oriented sectors. Technology often takes center stage during early expansion. With ample access to capital, tech companies invest heavily in research and development, launching innovative products and services. Consumer discretionary is another sector that thrives during this phase. Industrials also benefit as businesses ramp up production to meet rising demand. During early expansion, investors should consider increasing their exposure to these growth-oriented sectors. Section 5, Late Expansion, Riding the Wave of Prosperity. As the economy transitions from early to late expansion, it's like a wave reaching its crest. The pace of growth accelerates, and businesses enjoy strong profits. Consumer spending remains robust, fueled by a tight labor market and rising wages. However, inflation starts to rear its head, prompting central banks to gradually raise interest rates. During this phase, sectors that benefit from rising prices and interest rates tend to outperform. Energy companies see their profits soar as demand for oil and gas remains strong. Financials, particularly banks, thrive in a rising interest rate environment as they can charge more for loans. Investors should consider adjusting their portfolios to capitalize on these trends. Section 6. Early contraction, seeking shelter from the storm. The early contraction phase is like the first signs of an approaching storm. The economic expansion loses momentum and growth slows. Businesses become more cautious about spending and hiring while consumers tighten their belts. The stock market typically declines as investors anticipate lower corporate profits. During this phase, defensive sectors come to the forefront. Consumer staples, often considered recession-resistant, provide a safe haven as demand for essential goods remains relatively stable. Healthcare is another defensive sector that tends to hold up well during economic downturns. Utilities also offer stability during early contraction. Investors often flock to utilities for their stable earnings and attractive dividends. As the economic landscape shifts, investors should consider increasing their exposure to these defensive sectors. Section 7. Late contraction. Preparing for the rebound. The late contraction phase is the darkest hour before dawn. The economy hits its trough and the recession deepens. Businesses and consumers alike hunker down, waiting for signs of a turnaround. However, this phase also presents an opportunity for astute investors to position themselves for the next expansionary cycle. During late contraction, interest rates are typically at their lowest point as central banks try to stimulate the economy. This creates an environment where growth-oriented sectors can begin to recover. Technology companies often start to show signs of life as they develop new products and services. Consumer discretionary can also present opportunities as investors anticipate a rebound in consumer spending. While it may seem counterintuitive to invest in growth-oriented sectors during a recession, remember that the stock market is forward-looking. Section 8. Timing your moves. Recognizing the signals. Timing is everything in sector rotation. Knowing when to rotate in and out of different sectors is crucial for maximizing returns and managing risk. While predicting the future of the economy is impossible, several indicators can provide clues about the direction of the economic cycle. One key indicator is interest rates. Rising interest rates tend to benefit sectors like financials and energy, while falling rates favor growth-oriented sectors like technology and consumer discretionary. Pay attention to central bank announcements and economic data releases. Another important indicator is inflation. Rising inflation often leads to higher commodity prices, benefiting materials and energy sectors. Track economic data releases and look for trends that confirm or contradict your outlook for specific sectors. Section 9. Sector ETFs. Your tools for efficient rotation. Sector exchange-traded funds, or ETFs, are invaluable tools for implementing a sector rotation strategy. ETFs allow you to invest in a basket of stocks representing a specific sector, providing targeted exposure without having to select individual stocks. This can save time and effort while achieving diversification within the chosen sector. When selecting sector ETFs, consider factors such as expense ratios, trading volume, and the underlying index tracked by the ETF. Lower expense ratios mean more of your returns go back into your pocket. Higher trading volume ensures liquidity, making it easier to buy and sell shares at favorable prices. The underlying index determines the specific companies included in the ETF, so choose one that aligns with your investment objectives. Numerous sector ETFs cover each of the 11 sectors. By incorporating sector ETFs into your portfolio, you can efficiently adjust your sector allocations as the economic cycle evolves. Section 10. Conclusion. Navigate the market with confidence. Sector rotation is a powerful strategy that can help investors navigate the ever-changing market landscape. By understanding the economic cycle and its impact on different sectors, investors can position themselves for success. Like a skilled sailor adjusting their sails to catch the wind, investors must be adaptable and adjust their portfolios to reflect the prevailing economic conditions. By incorporating the insights and strategies discussed, you can approach the market with greater confidence and potentially enhance your investment returns. Remember to conduct thorough research, stay informed about economic trends, and utilize sector ETFs to efficiently implement your sector rotation strategy. By understanding these risks, staying informed, and making well-informed decisions, you can increase your chances of success and navigate the market with greater confidence.